What's going on, guys? I have a huge PSA, a public service announcement. Oh, wait, that's actually just the ticker of the stock we're going to talk about today, Public Storage.
You say,
So, we all know how great of an investment real estate is. But public storage probably isn't what comes to mind when you think of it. You're probably thinking of residential or commercial properties, but public storage operates as a self storage facility. And me being the minimalist I am, I have actually looked up if you can use a storage unit as a residence. And sadly, this is against the law. Self storage is a hot investment because they actually don't require that much capital expenditure to build and maintain. When I'm buying a house, I want it to have the nicest bathrooms, remodeled kitchens, floors, new roof, you name it. But when I have excess stuff, I just want to leave it somewhere, and I don't care how nice the paint on the wall is or the type of cement they used, as long as it's a safe haven for my possessions. Also, the key to typical real estate is location, location, location. You want to buy in the cornerstone of a city or the best expensive suburb, while with self storage, you can get by getting cheaper land since location isn't really high on a renter's list. While typical residential real estate may have high turnover, self storage facilities typically don't because it kind of becomes one of those monthly recurring expenses that just gets lost in auto pay, along with Netflix, internet, utilities. When one gets a storage unit, they are likely going to be using it for the long term unless they can magically create some new space. It's also a hassle to have to come and clear out the space if one was to withdraw from the lease. That's really just an inconvenience, and most people would probably just continue to pay and not have to switch self storage facilities. This has held on through during recessions as well. So you know that this is a proven business model that generates good returns on invested capital. Now, for a company that actually operates in this space, Public Storage has been around since 1980 and they have over 2,400 facilities in 38 different states. Because self storage facilities are relatively inexpensive, they can usually break even with just a 30% occupancy rate. Public storage, though, currently has an occupancy rate of 92.5%. That means it has triple the break even point margin of safety. This also helps them support a spectacular balance sheet of nearly $11 billion in assets and just over $1.5 billion in liabilities. With a market cap of over $40 billion, that should be nothing for this company to cover in times of a recession. PSA, or Public Storage, is one of the most highly rated REITs by major rating agencies such as Standard & Poor's as well as Moody's. As with all REITs, anytime there is falling long-term interest rates, REITs typically do very well. And the inverse is also true, meaning when there is rising interest rates, REITs may get hammered down. Public storage generates a little under $2 billion in net income each year and has insane margins of nearly 60%. Free cash flow per share has also increased each of the last 3 years according to its 10K. I like public storage because this is an industry that technology cannot disrupt. Sure, you have computers making storing files and media much easier, but tell me, how can we digitalize your spare mattress or your grandma's rocking chair? I'll wait on that. Public Storage has most of its stores in the 20 most populated metro centers in the United States. In fact, that's where 71% of their revenues are generated. This is a competitive advantage that other small self-storage operators do not have, as they don't have the market share and presence in those metro areas. Public Storage has 7% of the market share in the self-storage industry, which may seem like very little, but they are actually the largest owner of self-storage facilities. In fact, the five largest companies make up just 15% of the industry, meaning the other 85% are typically smaller mom and pop shops that have nowhere near the economic resources and market data to compete with Public Storage. The Public Storage brand name is also the most recognized and established in the industry due to its locations in 38 different states and very distinctive orange colored doors and signage. I mean, who doesn't like an orange door? Public storage was the most frequently used search term by customers who were on the internet doing searches for self-storage. While the company may pay out $8 in dividends a year, it does not consistently raise its dividend year over year. But generally, over time, it does increase its dividend payout. Public Storage did drop 3% on October 25th and could now be trading at an attractive value. Let me know what you think of them in the comments and if they're at a fair valuation. While Public Storage is the industry leader, let's take a look at another smaller competitor called Extra Space Storage. Wow, do these storage companies come up with some really creative names. Since its inception in 1977, Extra Space has over 1,600 stores, also coincidentally in 38 different states. Maybe somebody should tell these companies that we now have 50 states and not 38? Similar to PSA, Extra Space offers month-to-month rental of storage space for personal or business use. With a market cap of just $14 billion, Extra Storage may still have plenty of room to grow. They have been rapidly trying to expand and acquire smaller companies. In fact, just in this past decade, the number of stores that they own has nearly doubled. Furthermore, Extra Space Storage's return on equity in the past year is 16.71% compared to the industry average of just over 5%. This reflects that the company reinvests more efficiently compared to the industry. As more and more millennials choose to rent rather than buy homes, they're going to need somewhere to store all that junk that they buy. Just like Public Storage, Extra Space has a ridiculous 91% occupancy rate, which means they will have consistent cash flows derived from the rents paid by tenants to cover their expenses and continue paying out those sweet dividends. Its free cash flow has increased each of the past 4 years, and it currently has a dividend yield of around 3.2%. And that has really grown from just 14 cents in 2011 to 90 cents a share by 2019. But the real reason why I highlighted this stock is for its ridiculous growth in the past 10 years. If you had invested $10,000 10 years ago with this stock, it would now be worth more than $150,000. That's an 875% return, which, believe it or not, is 2 times bigger than the return of the largest company in the world currently, Microsoft, in that same time span. Of course, past performance is not an indication of future performance. So let's just hope that they can keep this momentum going. Alright guys, so let me know in the comments if you like this particular industry, if you really think it has potential. I think it's going to be around for a long time, and I don't really think it's going to be disrupted by technology, which is why I love it, and people are always going to kind of need a need for this particular type of stuff. The only way that people would get less stuff is if they become less materialistic, and we know Americans are anything but that. As always, guys, be sure to hit that subscribe button if you guys want to see more videos like this in the future.